Hi, good morning. I'm sorry, I'm having a bit of internet issues. Just try to figure that out. 1 second, please. Because I can't seem to log in as host. And without that, it's a problem. It looks to be a problem with the university network. Okay. So last time we were talking about multiple space models and we were talking about discounted cash flow models. And just to remind you, in terms of multiple space models, we spoke about the fact that you can use any type of multiple, whether it's PE ratio, PBV ratio, price to cash flow, price to EBITDA, right? It doesn't matter the multiple that you're given. You can use these multiples to forecast the price of the company. And these are quick and easy ways to forecast the company because it's not very accurate. You're using peer multiples and saying, my company should be trading at the same levels my peers are because I'm in this industry, because that peer looks like me. So there are problems with multiples based valuation, but it is a very quick and easy valuation just to try and figure out what rough levels the company should be trading at based on other companies that look like it, right? So you can use peer multiples, you can use industry multiples, you can use market multiples. But the more that it looks like the company, the better the multiple based valuation is. Then we went to free cash flow based valuations, free cash flow based approach. And all that happens in free cash flow based valuations is that it is also a discounted cash flow valuation. It is also a discounted cash flow valuation. Only thing is, there are two ways to do it. You can do it either looking at the firm, what we call the enterprise value of the, enterprise value, right? That is the value of the entire firm. Now, remember, the entire firm is made up of how does the firm, what does the firm's capital structure look like? It gets money from its shareholders and it gets money from its creditors. And that's the money that it uses to generate profits. So, by forecasting the firm's cash flows, that's cash flows that are available to be paid to both equity holders and debt holders, creditors, right? By forecasting the firm's cash flows, I can come up with, in today's value, how much is my firm worth, my enterprise value. This is the value that belongs to both my debt holders and equity holders. So if I want to get the value of equity, because I want the share price, I don't want the bond price, I don't want the company's price. As a shareholder, I want the share price. So once I get the value of the firm, I have to now find, but how much are my shares worth, right? So once I get the value of the firm, I have to take out the impact from the bondholders. So for that, because it's in today's prices, because I have forecasted all the cash flows to the future, because I have forecasted all the cash flows to the future. What cash flows to the future have I forecasted? I have forecasted all cash flows. We call it free cash flows that belong to both debt holders and equity holders. Free cash flows to the firm, right? So free cash flows to the firm, I have kept on forecasting how much cash flows am I generating, looking at my profitability, looking at the working capital, looking at the capital expenditure that I require to generate those profits, right? I'm forecasting how much cash flows I can generate over the next number of years. So typically, when we do this type of valuation, we will prepare a profit and loss statement, we will prepare a balance sheet, and then using the profit and loss statement and balance sheet, and this is not this year's profit and loss statement and balance sheet, we will forecast a profit and loss statement and forecast a balance sheet, right? So every line item, how will my revenues grow? What are my margins going to be? What are my administration costs, operating costs, all of these. And for this, do I need to borrow more money? What is my capital expenditure, my property, plant, equipment? Do I need to purchase? Do I need to expand? Looking at the business plan of my company, either myself, which is the company, or the investment bankers or analysts, right, will typically forecast the profit and loss statement and the balance sheet of the company. And then using the profit and loss statement and the balance sheet, they will forecast the cash flows, but not the normal cash flows that we like what are our three statements? We have the profit and loss statement, we have the balance sheet, and we have the cash flow statement, right? Not the usual cash flow statement. We come up with, it's like the usual cash flow statement, but we stop at a certain point. We find what are the cash flows that can be used to pay back the creditors and to give money back to the equity holders, right? What is available to pay back the creditors and to pay out dividends to equity holders, right? That's what we forecast. We call this the free cash flows to the firm. So we forecast this as long as the firm is running an operation. So we forecast it to infinity. So typically, forecasting models will look like our dividend discount models. It can be that there is a no growth situation. It can be there's a constant growth situation. It can be that there is multiple growth situations where you have different levels of growth for the first few years, which are the known years, which are easier to forecast. And then we use simply a constant growth to forecast the rest of the period, right? So it can be any of these, but using these free cash flows to the firm that I forecast, I discount this back. So I discount each of these cash flows to today's value. All of these future cash flows to today's value. Now, once I discount and I add up all of these future cash flows, what do I get? I get the present value of all of my future free cash flows to the firm. Right? Free cash flows to the firm. But because this is when I discount all my cash flows, when in the dividend discount model, when we discount all the cash flows, what we get is the value of the company, right? but the value of the company that belongs to the value of equity. Here we don't get the value of equity because the cash flows we have used are the cash flows available to both bondholders and shareholders. Therefore, we get the value of the firm, what we call the enterprise value. Okay. Now, as a shareholder, this is not what I want. I want to know what is the share price. Is the share overvalued, undervalued, fairly valued, right? So I have to make an adjustment. Because this is the present value of the firm, from this, and this includes the debt holders component, I have to take that out. So what do? I look at today, how much debt do I have? It is typically net debt. Right? Net debt means your gross debt minus cash. Because that cash that is there today can be used to pay back this debt. Okay? So my enterprise value minus my debt, typically net debt, or if I use my gross debt, I have to add back the cash. Cash that is there today in years. And this value is the value of your equity holders. Right? This is what we call a free cash flow to the firm valuation. Free cash flow to the firm valuation. And once I have the value for my equity holders, I can divide that by the number of shares to get my per share value. Okay. Same way, I can do the same thing, but now I straight away find what are the cash flows that belong to my equity holders. Instead of doing this calculation where I use cash flows to both debt and equity holders, another way to look at it is I look at only the equity holders. Right? So I do the same way. I forecast my profit and loss statement. I forecast my balance sheet. But now when I'm constructing my cash flow statement, I bring it down to the level of equity holders. How much dividends can I distribute or how much money is available for me to give me back to my equity holders? Right? This is what we call free cash flows to equity. Free cash flows to equity. So these free cash flows to equity, I keep on forecasting for the next number of years. And here also, just like before, until the company is there, so we assume that the company is there forever. And we keep on forecasting this. We can either use a no growth model, constant growth model, or multi-growth model, where we have different types of cash flows at the beginning period and towards the end of the period where we can't keep on forecasting. I don't know, like my accuracy of my forecasts are more correct towards the first 5 years, right? Versus after I start the next 5 years or the next 10 years or 20 years, the accuracy of my forecast come down a lot, right? So because of this, we use a simple assumption. And we look at, okay, maybe something like a constant growth model, which we look at, the cash flows will keep on growing at a certain rate forever. And looking at these different cash flows, we can do the same thing. We can discount these cash flows to today's price. Right? Now, one thing I forgot to say in the previous, when we were discussing the free cash flows to the firm, at what rate did we discount free cash flows to the firm? What is the discount rate? Because it belongs to both the debt holders and the equity holders. What is the discount rate that we use?
The average cost of capital.
Yes, the weighted average cost of capital or the WACC, right? What is the WACC? The WACC is the average, right? The weighted average cost of capital. Now, when I want to figure out how much I owe my equity holders, or what is the required rate of return, not how much I owe, what is the required rate of return of my equity holders, we call that the cost of equity, my required rate of return on equity. When I want to know, when I look about my debt holders, there is a cost of debt, right? My required rate of return on debt. Meaning, if I'm going to invest in debentures of this company, or there is a return that I want to. I'm not going to invest in a company that's giving me debentures at 9% right now. Okay. Recently, Commercial Bank came up with debentures at 13%. Right. That is based on the consensus market agreement in terms of what they thought they could offer the market and raise the amount of money that they wanted to raise, 10 billion or 20 billion, I think, right? To raise that amount of money that they wanted to raise, they felt that this was the cost of debt that they would need to offer, the required rate of return that their debt holders would be asking, right? So that was the rate that was offered, and that is how they make that issue successful. So that's the cost of debt. So cost of equity is if you invest in shares, remember your required rate of return for investing in shares. And usually there are many, many ways to figure it out, but our usual way of figuring it out is the CAPM equation. So we look at how much equity, what is the percentage of equity that is there in this company into what is the return the shareholders want for equity, what is the percentage of debt in this company into how much debt holders want for that. And debt should be after tax cost of debt, not pre-tax, because equity is also, anyway, you're looking at after paying your taxes, but there is nothing on equity, right? You're after tax. And sorry, that's not the reason, because there is a tax shield on debt, right? Because when you take debt, you can claim a certain amount of taxes against your interest cost. So we say we use after tax cost of debt plus your cost of equity, and we look at the weights. How much debt do we have? How much equity do we have? What is the target debt that we want to have? What is the target equity we want to have? And that's what we call our weighted average cost of capital, right? So our free cash flows to the firm, because it belongs to both the debt holders and equity holders, we don't discount it by the cost of debt, our required rate of return on debt. No. We don't discount it on cost of equity. We discount it on the weighted average of the two. Free cash flows to equity, we discount it on your required rate of return on equity. Once we discount it, we come to the present value of my future free cash flows to equity holders. Now, straight away, I have found what are the free cash flows that are available to equity holders, right? Only thing is, these are the cash flows that are available to equity holders, the future cash flows that are available to equity holders, right? I haven't taken the current cash into consideration. So this is the value of equity of the company. If there is any current cash, that's also something that I can use to pay out our equity holders, right? So this is the value of what we call equity. Excuse me. Okay. So that's how we come up with. So in terms of what is your free cash flows to the firm and what is your free cash flows to equity, how do we come up with that? Once we forecast the profit and loss statement, free cash flows to the firm is where we now need to forecast the cash flows. So when we take the shareholder statement, sorry, what do I say? The profit and loss statement, right? We take EBIT. EBIT into 1 minus T, that's essentially net income without considering the interest component, right? Essentially your earnings or net income, without considering the interest component. So EBIT into 1 minus T, that's your cash flow without the interest component, because we're looking at the firm. Interest is available to be paid to debt holders. No? So we're looking at the money that is available to be paid to the debt holders. So you start from that. Then add back any non-cash. So depreciation is a very easy terminology I have used. Actually, it's not just depreciation. It is any non-cash item, right? Any non-cash component. So you add it back. From this, I reduce any capital expenditure that I have, any increases in working capital. That is, working capital means my current assets minus my current liabilities. Current assets minus my current liabilities. But when we say increases in net working capital is your current assets minus current liabilities. It's your increase in current assets minus your increase in current liabilities, right? Increase in current assets minus your increase in current liabilities. That's your free cash flows to the firm. This is what is available to be paid out to debt holders and equity holders. And there are many, many equations. From time to time, you will see these equations will pop up, right? And then your free cash flows to equities, I have to now look at how much is available to equity holders. So from the debt holders, after I pay off their interest expenses, and I look at how much money that I have taken or spent, right? After I consider that, this is how much money that is available for me to pay dividends to shareholders or pay any cash flows to shareholders, free cash flows to equity. So based on that, we did one question. We had another question pending. Did y'all try this? Any problems with this question?
In increasing net working capital, I got a question because I got a minus 300.
That can happen. That can happen. That's perfectly fine. Increasing net working capital. So you have to look at what is your increasing current assets, right? So this is your -1 last year, and this is today. So what is the increasing current assets? 326 minus 201. How much is that? 326 minus 201.
120.
125. That's the increasing current assets. And then your increasing current liabilities, 141 minus 57. 84, right? So 125 minus 84, you get a positive figure. Is this how you
I
did it?
did other way around. I did other way.
Right. So it's current assets minus current liabilities, increases in current assets minus increases in current liabilities. Right? Working capital is always current assets minus current liabilities. When we look at the increase in working capital, it's increasing current assets minus increasing current liabilities. So increasing current assets minus increasing current liabilities, we get 41. So calculate the free cash flows to equity in year 0. Now here, free cash flows to equity today. So here you have your sales figure, This is your non-cash component, right? Non-cash. Other operating costs are cash, right? Because you paid it. The only difference is what we are doing with this increasing current assets and increasing current liabilities. When we say other operating costs, let's take something like selling and distribution and salaries and so on, right? So when we say your other operating costs, there is a component we have paid. What we have paid is actual cash that has moved out of our hands, right? But there is a component that might be payable. Payables come to the profit and loss statement. We have to take that out, right? Payables come to the profit and loss statement. We have to strip it out because it's not actually cash. No? We say my salary bill up to December is, and I put a figure, let's say 100 million, right? My salary bill up to December is 100 million. But of that 100 million, maybe the December bill is not yet paid. So maybe for the December bill, there is 10 million to be paid, right? But in my profit and loss statement, I am saying my salary bill is 100 million. For the 12 months, my salary bill is 100 million, right? So in that salary bill, my actual cash that I have spent from the company is not 100 million because 10 million has not been paid. It's a payable. That payable comes under my liabilities, right? It's shown under my liabilities. So I have to strip it out, which is what we do by the increase in net working capital, by looking at our receivables and our payables, right? We strip out all of those receivables and payables and to bring our profit and loss statement to a cash flow statement, we have to take out inside the profit and loss statement, there are receivables and payables. So I have to take all of that out. That's what we do by looking at the changes in working capital, right? Now, the other thing about this profit, so this depreciation is non-cash, so we have to anyway take that out, right? Depreciation is non-cash, so we have to anyway take that out. So what do? We can start with a point like this. Now, here in this income statement, income before taxes are given. Taxes are anyway cash payment. Here also inside taxes, there might be payables or receivables inside the tax statement, right? So that will be taken care of under my net working capital. So here I have net income. Now, all this time, the equations that have been given to you are EBIT and EBITDA. Now you have net income. So how do I start? If I have net income to start with, not EBIT or EBITDA, I have net income, right? Because I have my actual taxes with me. I don't know the tax rate here. That's a problem, right? So if the tax rate is given, I could have used 1 minus tax rate, right? Remember, this 1 minus tax means tax rate. Obviously, 1 minus tax is not 1 minus 100,000 or 100 million. It's 1 minus 35% or 1 minus 65%, right? Whatever, right? Your tax rate. So your EBIT into 1 minus tax rate. EBITDA into 1 minus tax rate. But I don't know, in this example, I don't know what the tax rates are. I know the taxes. Inside these taxes, there can be payable receivables as well, which will be taken care of under my net working capital. Right? So I have net income. How do I start with net income? Now, if you look at this equation, I want free cash flows to equity, right? That's what they're asking. Free cash flows to equity in year 0. So free cash flows to equity is a combination of free cash flows to the firm minus interest expense plus increases in net debt. Look at the equation. Free cash flows to equity, I can rewrite, is actually free cash flows to the firm. So what is free cash flows to the firm? EBIT into 1 minus tax. Tax rate. Plus non-cash components like depreciation. Minus any capital expenditure, like I'm buying a property, plant, equipment, something. Any capital expenditure I'm spending, so cash that I require for that. And minus any increases in changes in working capital, right? Minus, this is just the free cash flows to firm bit. From this, I can also take out, I also have to take out my interest into 1 minus T tax rate and any increases in, add back any increases in net debt, right? Do you see, when I look at this component, EBIT into 1 minus T minus I into 1 minus T. What is that? EBIT into 1 minus T minus I into 1 minus T. I can rewrite that to be EBIT minus interest. What is EBIT minus interest? Into 1 minus T. And then all the other components of this equation comes in. But these two, I can rewrite as EBIT minus interest. That's when I take out interest, this is my earnings before tax into 1 minus T. Earnings before tax into tax is what? Earnings after tax. What is earnings after tax? Net income. So my free cash flows to equity can be rewritten as net income plus my non-cash components minus capex minus changes, increases in net working capital plus the net debt. Because these two that I have highlighted have been combined to net income. Yeah. So the equation can be written as this. Net income, you add back the non-cash items, depreciation and so on, right? From that, you deduct any changes in net working, increases in net working capital, because your net working capital has your payables and your receivables inside it, and you deduct your capex and add back your net debt. So when I look at this here, then what is my free cash flows to equity? It's my net income, add back my non-cash items, minus, right, my increases in working capital, changes in working capital, deduct my any capital expenditure that I have. Capex, I've given you the equation on top, right? Change capex, how to calculate capex. Add your net debt. Okay. So where do we start with? What is my free cash flows to equity? Net income is
80.
non-cash items. I had to add back non-cash items to make my profit.
Depreciation 23.
Depreciation 23. Yes. Then I had to also adjust my income statement for payables and receivables. How much is that?
It's 41.
Yes. It's 41, 41 positive. So my working capital has increased, right? Working capital changes in working capital have increased. Current assets minus current liabilities have increased, right? What are my assets? My receivables. What are my liabilities? My payables, right? So my receivables have increased, my payables have decreased, and my receivables, because it's positive, have increased more than my payables, right? My receivables have increased more than my payables. So I have less cash now. That's kind of what happens automatically when you put it to the equation. You don't have to think that much. But automatically when you put it to the equation, that's my cash flows come down. This year, I haven't received that cash, right? So this 41, there is an additional 41 inside this profit and loss statement that is not cash. Yeah. Minus capex. How much is capex? Capex is the change in property, plant, and equipment plus depreciation. It's like this, right? Capex is actually the change in gross property, plant, and equipment. Gross property, plant, and equipment. Okay. That's capex. No, capex means the fact that I have a building. And if I, for example, and if I purchase another building and I spend, I don't know, let's say 500 million rupees and I purchase another land, another building, right? I'm spending that money. That's what I have to reflect in my cash flow statement. I'm spending that money. So it's negative cash, right? But when I put that into my balance sheet, accounting means that I am not saying that my building that was worth, let's say, last year I had buildings worth of 1 billion rupees. Now I purchased another building worth of 500 million rupees. So therefore, now my buildings are worth 1.5 billion rupees. So the difference is 500 million rupees. That's my property, plant, and equipment. That's not how it happens in the balance sheet, right? In the balance sheet, you have depreciation. Your property, plant, and equipment, or well, not your property, but your plant and equipment are depreciated, right? So here, this property is net property, plant, and equipment, not the gross. If it was the gross property, plant, and equipment, meaning the actual value of the buildings, then you can just take the difference and you have your answer as to how much money you have spent to buy that other building this year, right? If last year you had buildings of 474 and this year you have purchased some buildings, so now the total value of all your buildings are 489 or machinery is 489. Just looking at the increase, right? From 474, the value of your buildings have gone up to 489. That difference is because of you purchasing buildings, for example, right? If it was gross. But the problem is when we put it into the balance sheet, we put a net value after cumulative depreciation. After cumulative depreciation. Okay? So if I just put it like this, your capex is like your, let's say, property, plant, and equipment this year minus your property, plant, and equipment last year, right? But your gross property, plant and equipment this year minus your gross property, plant and equipment last year. But what is shown in the balance sheet? In the balance sheet, I have net. What do I mean by net property, plant and equipment? I have my gross property, plant and equipment, right? Minus the cumulative depreciation up to, let's just make this, let's say this is 2023 and this is 2024, right? So gross property, plant and equipment minus the cumulative depreciation up to 2023 is the net property, plant and equipment as at 2023, right? The net property, plant and equipment as at 2024 is the gross property, plant and equipment of 2024 minus the cumulative depreciation, right, up to 2024. Up to 2024. So, do you see this is the net value for 2024, this is the net value for 2023. I want the difference between the two gross values, not the difference between the two net values. So what do I have to do? I have to add the cumulative. So if I'm using the net values in the balance sheet, I have to add the cumulative depreciations from 2023 and this one up to 2024. But when I look at the difference between cumulative depreciation up to 2023 and the cumulative depreciation up to 2024, what is that difference? What is that difference?
This year depreciation.
This year's depreciation. This year's depreciation. That's why when we use CapEx, we say to look at CapEx, we look at this year's net property, plant and equipment, if you're using net, right? So let me just adjust this equation. It should be, if you're using gross, no adjustment. But if you're using net, you look at the current period minus the prior period and you add back this year's depreciation. And that's enough for you to come up with what is your CapEx for the period. Okay. So how much is your CapEx for the period? Say that again.
38.
38. 38 is 489 minus 474 is how much? 15, no?
15. So plus 20.
15 plus 23. Correct. CapEx is 15 plus 23. That's my CapEx. Plus net debt. Do I have debt here? Long-term debt, 0. No debt in this side, this company. So no adjustments need to be made here. How much is my free cash flows to equity?
24.
20?
24 as well.
24. 24. Right. Okay. So that's your free cash flows to equity. For year 0. Year 0, free cash flows to equity is 24. Now, use that to do the second part of the question. Mhm. Sorry, go ahead. This is very easy, right? Now, all you do is just like the dividend discount model. What is the cash flow you're looking at? You're looking at your free cash flow. It's not dividends, it's money that's available to be distributed as dividends. So, what does your cash flow statement look like? You have year 0, 1, 2, 3. Okay. What does your year 1 cash flow look like? Your year 0 cash flow, do you take that into account or not? Do you take that into account or not? How much is your year 0 cash flow? How much is your year 0 cash flow? Yes. Year 0, how much is your free cash flows to equity?
24.
24, right? 24. So you start with 24. But my question is that an actual cash flow that you will consider in the valuation?
No.
No. Right. But if you do need it to do the rest of the valuation, right? Year 0, your cash flow, free cash flows to equity are 24. It's not a cash flow you will consider in the valuation, but you need it to calculate year 1's cash flow. Year 1 cash flows have grown by 27%. So how much is the cash flow in year 0? Sorry, year 1.
30.48.
30.48. Okay. And then again, that cash flow grows by another 27% to year 2. So how much is your cash flow in year 2?
38.70.
33, is it?
38.70.
38.70. So it says it will grow at 27% for 2 years. So first year growth, second year growth, and 13%. This assumes that you all will make that assumption indefinitely thereafter, right? Indefinitely thereafter. So now you come to the constant growth stage, and this is going to grow at 13% forever. Right? 13% at a constant growth forever, right? Just add this, please, indefinitely forever. So how much is your year 3 cash flow?
43.7.
43.0.
73. 73.
43.73. Okay. Now, how do I find the value? What do I need to do next? I need to discount it to today's value. How do I do that? I discount it at what rate?
ROE.
ROE. Yes. ROE is 14%. So what do? I take the first cash flow. Sorry. We have to do that. But before that, there might be something else you want to do. Anything else now you need to do? What's the next step? What's the next step?
Calculate the terminal value.
Calculate the?
Terminal value.
Yes. Calculate the terminal value. So calculate the terminal value. All these future cash flows, we can say, belong to year 2, right? Belong to year 2. All these future cash flows, right? So what are these future cash flows? So the dividend discount model says the value at any point of time is next year's dividends divided by R minus G. It's the same here, but instead of dividends, what do we use? It's next year's cash flow to equity divided by R minus G. What is R? Cost of equity. Right. So how much is that? Next year's dividend is 43.73 divided by R is 14%, G is 13%. Okay. So 43.73 divided by 0.01, all of these future cash flows come to 400. Is it 4,373?
Yes,
4,373. Is that it? So what are my cash flows in year one? What are my cash flows in year two now? What are my cash flows in year one? Not. What are my cash flows in year one? Yes. What is the answer? Okay, Devaka, I'm waiting for the others. Anybody else to come up with the same answer or different answers? So how much is your cash flow in year one?
30.4.
30.48. And in year two?
38.7096.
Is that it though?
And we have the terminal value.
And the terminal value. Yes. So how much is that? 4411, is it? And then what we do, we have to discount these two cash flows. 30.48, we discount at 14%. for 1 year. 4 for 170. We discounted 14% for 2 years to come up with the value of my equity in year 0. Which is it 3422.24? Is that right? Okay, I'm going to take silence as we have to move on and you're taking too much time. I'm going to take silence as it is correct. If it is wrong, then you will find out when you're actually working out the question on your own, right? So one thing here, one thing to note here, current assets here have been given on an amalgamated basis, right? So we don't have any further information. Technically, this should be current assets excluding cash. Excluding cash. Because we don't use for free cash flow evaluations, we don't use cash and equivalents to do the cash flow statement, right? That's not something that we do. So current asset should exclude cash. So increasing current assets, meaning excluding the cash component minus increasing current liabilities, right? And then once we get the free cash flows to equity, this is the value of the company. This is the value of the company to the equity holders, once we get the free cash flows to equity, the present value of your free cash flows to equity, if cash has been given, today's cash balance we have to add. We have to add that, right? But that's not being given in this sum. Okay. So a few things to remember here. We did the dividend valuation model, right? Dividend valuation models. We did relative valuation models, and we did free cash flow valuation models. Dividend valuation models and free cash flow based valuation models are very similar, pretty much the same. If you use certain assumptions, you could probably get the same answer using any of these three models, right? Free cash flows to the firm, to equity, and dividend discount models, right? So only thing is there are certain assumptions that you will have to make. So in real life, you will not get the same answer, but you should get something close enough. Now, dividend discount models are good enough for equity investors who are outside of the company, who doesn't see a lot of insight from the company. If the company is not giving you a lot of insight into their future plans, then, but you know that they are consistently paying dividends, and their dividends have been in the past, they have a consistent pattern of how they pay dividends. That's something that you can use to establish what is the dividend that you can expect. And therefore, you can use the dividend discount model. And as a shareholder, that's enough for you, especially if you're a minority shareholder, right? Versus if you have more visibility into the company, if you know what the company's future plans are going to be, you can then forecast the profit and loss statements, the balance sheets, and then use that to forecast the cash flow statements to come up with your free cash flow models. But for this, you understand there's a lot of assumptions. When I'm forecasting the profit and loss statement for the next 5 years, I make assumptions on revenue, on cost of sales, on admin expenses, on distribution expenses, on marketing expenses, on the debt that I'm taking, on my future CapEx capacity, expansion plans, right? Property, plant, equipment I want to buy, right? So I'm making such a lot of assumptions. this is some of the bigger errors that we have in your free cash flow based valuations. Free cash flow based valuations and dividend discount models are better than relative valuations, are better. But because relative valuations we are just looking at another company and saying, oh, my company looks like that. This company looks like that company. So they should have the same value. Right? Which is not always the case, right? There are intricate differences between the two companies. Within an industry, between two companies, there are differences. By combining the ratio and amalgamating it to say amalgamated industry ratio, also there are errors. I'm using the average industry ratio to value my company. I might be better than the industry. I might be the high performer in the industry. So it's prone to errors, but relative valuations are very quick and easy valuations. You should know that it's not a correct valuation, but it is an easy way to come up with a baseline scenario. Dividend-based valuations or free cash flow valuations are better. I'm actually using some rationale, common sense, logic to figure out what will this company do specific to this company, right? Obviously, free cash flow based valuations are better than dividend based valuations, right? Because free cash flow based valuations are modeling the company's future plans in a very detailed fashion. But it is not obviously better if everything is an assumption. If I don't have any insight to the company, all I'm doing is putting numbers. The revenue will grow by 10%. The cost of sales, they are going to maintain at 25% GP margins. You don't have any insight to the fact that they are buying a new, let's say a new furnace, which is going to improve their efficiencies and therefore their their costs are going to come down by this much, right? You have no insight to the company. All the numbers that you put are just garbage. We say garbage in, garbage out, right? So it's very important for you to figure out in terms of estimating your growth rates, in terms of estimating your risk, in terms of forecasting your dividends, and in terms of forecasting everything on your free cash flow models, to be very to have more insight into the company when you're doing that. So which is why free cash flow based valuation models are good for analysts who have continuous discussions with the companies, for investment bankers who have more insight to the company because they're working closely with the company on a deal, and for the company itself because they know what they're going to do with the money that they get, right? So free cash flow based models are good for either majority shareholders or for any person who has high interactions with the company where they can get better quality information. Otherwise, all you're putting is a bunch of numbers and you're getting a number out and you're saying this number is correct, but it's all assumptions. Revenue growth is assumption, revenue is assumption, cost of sales is assumption, administration expenses are assumptions, receivables, payables are assumptions. Everything is an assumption for the next 5 years, 10 years, and then we do a constant growth forever, right? So if you want those assumptions to give you a number to say this is the correct number for my company, those assumptions need to be refined and thought through and logical and discussed with the company. Discussed with the company doesn't mean that you believe everything the company says. You have to do your own channel checks, your own verifications, but you have to have an insight to the company's plans and strategies to be able to come up with a good free cash flow valuation model. Okay. So remember that although your asset pricing models are better than your relative valuation in terms of discount, cash flow discount models are better. Cash flow discount is dividends are also cash flows. Dividend discount models are also a cash flow discount model, right? They're better than your relative valuation models. Everything that we use is an assumption. So the more information that we use that are pure assumptions, the less accurate your model is going to be. Let's do a past paper question. So this is 2 years ago, 2022. So in your past papers, either on the LMS or if you have the past papers downloaded, this is the one that I have marked as 2022. Right? I have a different numbering system for the past papers. So this is the year the exam was held. So the 2022 past paper. Right? So it's a case study. Question number 1. This is the exhibit. Read through the exhibit. I'll give you 5 minutes. Read through the exhibit first, and then look at question A. So you don't have to look at these small figures. You can download the paper. It's question, 2022, question number 1, exhibit 2 and question 1. So this is on Musk's Twitter acquisition, right? When he acquired Twitter a couple of years ago, the things that he went through, how did he value the company? So this was on the valuation of the company. So in your exam, in your formula sheet, right at the end of the paper, there is a formula sheet, and these are the 2 equations that were given in your formula sheet. Calculate the free cash flows to the firm for each of the years 22 to 27. So you can see here when you read the case study, Musk has essentially given a bid to acquire Twitter, and he said he'll buy Twitter at $44 billion, right? And the board of Twitter has commissioned investment bankers, Goldman Sachs and JP Morgan, to advise them whether that bid is fair or not. This is a mergers and acquisition transaction by the investment bankers, right? Well, not by investment bankers. Musk has initiated the transaction, sorry, and the investment bankers are there to advise, work on behalf of the acquiring, right? So Goldman Sachs and JP Morgan separately have done their valuations, and they have to now advise whether that 44 billion offered by Musk to buy Twitter is a fair offer, whether it is at the best interest of the shareholders for the board to accept the decision or not. Right. So JP Morgan's analysis has been given to you. JP Morgan's analysis, essentially, they've forecasted free cash flows from 22 to 27 using management information, management forecasts, and then discounted it using a range of valuations, 10 to 12%. 10 to 12%. Now, this is typical. Usually now in everything that we did, the sums that we did, we discounted it by a required return on equity, required return on equity, right? And we use the CAPM model to find our required rate of return for equity, cost of equity. But CAPM makes certain assumptions. And one of the assumptions that CAPM makes is that everybody has the same expectations, homogeneous expectations, right? I mean, really, everybody doesn't have the same expectations. My required return on equity can be different from your required rate of return on equity. Remember, I spoke about that example last week where I said the person who has the lowest opinion of the risk that they are taking will determine the market price. So you come up with what should be the required rate of return on equity, but you keep some allowances for different investors having different opinions, which is what we call scenario analysis. So a good way to do valuations is to do a few scenarios, right? To figure out what is the best case, worst case, middle case, right? It doesn't need to be 3 scenarios. It could be 5 scenarios, right? If you're going into real detail, you can do a Monte Carlo simulation where you're looking at thousands of, like the computer will generate thousands of scenarios, and based on that, come up with an average value for the company. So like this, they've used scenarios. They've used scenarios where they made 2 important distinctions. One is the discount rate, where they've said they've used discount rates, different discount rates between 10% and 12%. And they've used different perpetual growth rates between 5.6% and 9%. And they've come up with a range of values for the shares, $39 to $60. Okay. And Goldman Sachs has done a very similar thing, very similar analysis. Independently, they have done a very similar analysis. Okay. So using management forecasts, right? It says estimated using management forecasts. And when you look at the management forecast, management is forecasting 1.6 billion EBITDA for 2022, right? And 5.4 billion by 2027. 5.4 billion by 2027. 1.6 billion to 5.4 billion. And it's forecasting revenue to more than double from 5.9 billion to 12.9 billion. And they're using these forecasts. They're using this management information, and Goldman Sachs is coming up with a value for the company. So Goldman Sachs has now used the management information, done some analysis, and these are the main figures that they have come up with. So using these figures, what are the free cash flows to the firm? That's the first question. What are the free cash flows to the firm for each of these 6 years? What do you have to do? What is there confusion or what is happening? What's the problem? Okay, set of values. Thank you. So how do you come up with this set of values? It's asking free cash flows to the firm. So I look at my formula sheet, free cash flows to the firm. I don't need free cash flows to equity. So this formula is not relevant, right? That's not relevant. I don't need free cash flows to equity. What I need is free cash flows to the firm. It says start from EBIT. Okay, I have EBIT. EBIT is there. Minus cash taxes. Cash taxes are there. Add back depreciation. It's there. Minus capex. It's there. Minus increases in net working capital. It's there. This is a very simple addition and deduction question, right? There's nothing for you to do. You start from this point downwards, minus cash taxes, plus depreciation, minus capex, minus increases in net working capital. So minus 47, minus 0, plus 702, minus 968, minus 11, which I'm told comes to minus 324. Minus 324, minus 1068.
India, only the first year is minus.
Okay, thank you. Plus 1068, 927, 2359, 1743, and 2100. Right. Okay. So now I have my free cash flows to the firm. And then it says, the question says, use the average perpetual growth rate. Use the average perpetual growth rate. So what is the average perpetual growth rate? Perpetual growth rate, they have done a scenario at 5.6% and they have done a scenario at 9%. What is the average? What is the average?
7.3.
7.3. And the average cost of capital, what is the average cost of capital? Remember, it's cost of capital that you're taking, weighted average cost of capital, right? The average cost of capital. Now, they've used a discount rate of 10 to 12. So what is the rate that you will use? So you use 7.3 and 11 and calculate the value of Twitter as at December 31st, 2021. If you're calculating the value of Twitter as at December 31st, 2021, what is this year? What is this year number? This is year? So you have one person talking, carrying the weight of the class.
0.
It's not right. 2022 is here. I was asking about 2022.
Then it's year one.
Sorry, say that again. There is?
Year one.
Yes. So this becomes year 1, 2, 3, 4. Use that. Use the fact that after year 6, you assume a terminal growth rate of 7.3%, right? What is the value for shareholders of Twitter? Right. Go ahead with the question. Fine. Sorry about that. Yeah, so this is where we were, right? So I was just trying to correct that error. Have you all done the question? Can you all start sending the answers in now? I finally managed to log in. You can send the answers in directly now. Okay. That's a per share value. No, I think that's not the final value you should get. Have you made the adjustment? I think that's not the final value. Were these the values that we had earlier? Use adjusted EBITDA. No, why are you using adjusted EBITDA? No, that's question number E. For part B, you had to use the free cash flows to the firm. 28, can you tell me what's the per share value? I remember the per share value. Twenty 2022 figure seems incorrect, but calculation is the same, right? So my figure should be correct. I think y'all had 297, if I'm not mistaken, earlier. But the calculation is the same as everything else, right? So are you sure that you all took the negative values correctly? Minus 302, right? So 2022 figure is minus 302. Ivanka, still there's a discrepancy with the final figure that I have. Just check again. So this is the answer to the first part, right? This 302. Just make sure that that's correct, because that's not the answer that we got earlier, but this should be the answer, 300 minus 302 for 2021. Now in the second part, we use a growth rate for the perpetual growth rate of 7.3 and a discount rate of, or in this case, it's the WACC of 11%. 11%, right? So WACC of 11%. Now, first and foremost, if the growth rate is 7.3, then 2028, which is year 7, how much should my free cash flows to the firm be? My free cash flows to the firm should be 7.3% higher. So, like this, that's correct. They are correct. Like this, from 2028 onwards, my cash flows will keep on growing, right? Indefinitely. My cash flows will keep on growing indefinitely. So, for this 2,273, this is my free cash flows to equity in the future, meaning growing at 7.3% forever. For that growth of 7.3% forever, I can apply the constant growth model. So if this is the cash flow at period 7, then the value at period 6 should be cash flow at period 7 divided by R minus G. R is 11%, G is 7.3%. Okay. So I get 60,900. Do you all also get 60,900? 2253.3, correct. 28. So 60,900. Okay. Then what's the next step? I look at, okay, what are my total cash flows? From year 1 onwards, these are my cash flows, and I discount each of these cash flows at 11% to today's value. Okay. And I add it up. Is this correct? Those who did the question, is that correct? 37,543.26. What is this value? What is this value called?
Enterprise value.
Is the enterprise value, is the value of the firm, right? So to this now I have to make an adjustment. What is the adjustment that we make? Of my, I have to make an adjustment or not? The value to my equity holders. Is this the price that I have to take the price per share? So here it says, no, yes. Using the average perpetual growth rates, providing parent, calculate the value of the Twitter share as at 31st December 2021. Right. Assume that the market value of net debt 1st December 2021 is negative 1,364 million. So what do we have to do? Net debt is negative 1,364 million. Do we make an adjustment or not? First thing, just because information is given doesn't mean that it has to be utilized. You should know whether it should be utilized or not. Should we make an adjustment or not? What do you think? Yeah, correct. You should deduct the debt, right? You have because I have debt and equity holders. So then I have to take out. Oh, is it okay now? Is it better? I'm told the line is not clear. Is that, are we okay now?
Now, okay, ma'am.
Okay, thanks. So as I was saying, enterprise value is what belongs to both debt and equity holders, right? So if it belongs to both debt and equity holders, I want what belongs to the shareholders. So because of that, I have to take out the debt component. Now here, the debt component is negative, right? Net debt. Debt component is negative because the cash component is higher. Net debt is what? Gross debt minus cash. But I have to take out that component anyway. So minus the debt, I come up with the value for the firm, for equity holders, of, this is the value to equity holders. Yeah. So that's the value to equity holders. And the final point is to look at the per share value. Assume 797.6 million shares. 797.6 million shares. So you get 48.78. That is the price that is one price in our valuation, right? According to the valuation, the share is worth $48.78 per share. Any questions here? Okay. So we've come up with the value of Twitter, value of a Twitter share, right? One scenario of the value of a Twitter share. Here in the case study, it said they conducted the following analysis, of which they used different discount rates ranging from 10 to 12% and different growth rates ranging from 5.6 to 9%. And they got a present value per share between $39 to $60. So we got $48. $48. So which is between $39 to $60. That's fine. Part C asks, assume JP Morgan calculated the best case and worst case scenarios. Of these combinations, what is the best case scenario? What is the worst case scenario? Of these combinations of discount rate and perpetual growth, when will you get the best case? When will you get the worst valuation? Best case scenario is where you get the best valuation, the highest price. And worst case scenario is where you get the worst valuation, the lowest price. What combination will give you the highest price? What combination will give you the lowest price? It's only 2 marks. You don't have to do any valuations. It's only 2 marks. What do you think?
The management forecasts are bias.
No, sorry, part C, right?
Oh, sorry.
We'll come to part D. Part C right now. Yes, part C, what do you think? We can't even take the break. Part C, what do you think? Correct, Rashmi. Yes. So the best case scenario, yes, Divanka. Best case scenario is when you have you want to make your valuation as high as possible, right? Your price as high as possible. So your valuation needs to be high as possible. How do you get the highest valuation from growth? Higher the growth, higher the valuation, higher the numbers, right? So in your best case scenario, your growth rate should be 9% of the figures that has been given to you. In your best case scenario, your growth rate should be 9%. If you grow this by, now we grew this by 7.3% forever. If you grow this by 9% forever, your D1 is going to be even higher. Remember, higher the growth, what will happen? Your price will go up, right? So even in your denominator, what happens? Even in your denominator, minus G increases. So that means your denominator comes down and your price goes up. So the highest growth rate gives you the best price. So your best case scenario is the highest growth rate, and from cost of capital side, the lowest cost of capital. Because the lower the discount rate, the higher the price. Lower the discount rate, higher the price, right? So best case scenario is when JP Morgan uses 10% discount rate and 9% growth rate. And worst case scenario, the lowest share price will be obtained in my valuation when I use the combination of 5.6% growth and 12% cost of capital. Any questions? Okay, part D. Sorry, Timothy, I think you were the one who started to answer, right? Part D.
Yeah, I was saying management estimates are generally biased. That can be a shortfall.
Yes. So generally, like I said when you want to use free cash flow valuations, you should be talking with the management. You should be having insights into the company, right? But here, if you look at the way JP Morgan has forecasted and look at the management estimates, management has said from 1.6 billion, EBITDA is going to grow to 5.4 billion. And from 5.9 billion, revenue is going to grow to 12.9 billion. Okay? They've essentially used the management forecast as is. Now, it is common practice to work with the management, talk to them, get the management forecast, right? But you can't use them as is. Because, like that was explained, management forecasts are biased. Management wants to show the best picture of the company, or in this case, because board of directors of Twitter is requesting to get a valuation done, they might even want to show the worst picture of the company. Actually, Twitter was a hostile acquisition, right? Twitter didn't want Musk to acquire Twitter. So it was a hostile acquisition. Musk gave the bid. The board, neither the board nor the employees were happy. They didn't want to take it. So it might be that the forecasts that were given were actually worst case forecasts. Okay. But if the management wants to take the bid, so they can be biased according to whether they want to take the bid or not want to take the bid. They can be giving forecasts that are very high or very low, right? So because of this, you can't just rely on the management forecast. You have to do your channel checks to see how are the other companies doing. You have to do comparable analysis, right? Other companies like Twitter, is this revenue type this growth that they are projecting, is it feasible? Can they achieve it? Do they have the capacity to do that? Can they do it with their current capacity, or do they need to grow in some other way, organic or inorganic? Like, you have to do your channel checks, right? So you have to separately verify the facts and figures before you just adopt what the management says. Because management numbers can be biased. When management wants to come out, even for an IPO, the numbers they give out, they will want the best value for their company, right? So who's to say that the numbers that they give out are accurate? It's up to the investment bank to verify to the extent that, are these reasonable? So although we say that you work with the company, and even when you're doing stockbroker research, you go to the company and you talk to the company and you try to figure out how this company is doing, and you're trying to put out a research report and do a valuation on that research report that you're distributing to a number of your customers. And same thing, companies will be biased. Companies never want to show a negative picture, right? So because of this, whatever the management says, always you have to do your verification. Is it possible? Is something you have to verify on your own. Otherwise, again, it's the same problem in terms of errors in valuation. And last part, okay, I just inserted it here, part E, part E. Okay. This is the ratio analysis. Y'all can try it on your own, but can you just read it before the break? I won't do it. We'll move on to derivatives, but just read through it and we'll discuss it and take the break. Part E. JPM is JP Morgan. So JP Morgan has identified a set of peers. Alphabet is Google. Meta Platforms is Facebook, Pinterest, Snap, right? They've identified a set of peers. And they've said these are the price to EBITDA multiples, price to adjusted EBITDA multiples of these peer companies, right? And you can't, in this case, you probably can't, because Twitter was making losses at the time this valuation was being done, right? So you couldn't use PE multiples to value the company. So the next best thing that they looked at was the price to adjusted EBITDA multiples, right? And it was more of a cash flow type valuation. So they used that price to EBITDA multiples, and they looked at the peer companies that they thought were peers of Twitter. And they looked at, okay, using this, let's do a relative valuation. Can you tell me how they would go about this? What is the relative valuation methodology now that they would use? How would they come up with the answer? What is the price of Twitter using relative valuation? You don't have to do the calculation. Tell me how you do it. What would you be doing now here? Yes. Okay, I'll give you 1 minute more. Otherwise, we'll take the break and we'll move on to the derivatives section. Right? You can figure it out on your own. Which beta on Twitter do you? Okay. Right. So you have these selected PI betas. Yeah, Divankar, correct. So what do? You take the average, right? You take the average. You just add up and divide by 4. 10 plus 6 plus 11 plus 30 and divide it by 4 to come up with the average EBITDA of the peers. Average price to EBITDA of the peers. So now I have the average price to EBITDA. Let's say that is 16 plus. I just say, so that's something like 12. I'm just putting numbers, right? This is not the correct number, right? Please don't think that this is the correct number. It is not. Average price to EBITDA of the peers is, let's say, 12 times. Okay. Then what do? You have to multiply it by to get the price of what is this company? Twitter, right? Price of Twitter. I look at, okay, I know the peer price to EBITDA. Right? I know the peer price to EBITDA. If I know the peer price to EBITDA, what do I have to multiply this with to get the price to price of Twitter? Price of Twitter. Remember, what do you do in relative valuation? You're assuming the price to whatever of this company, right? Price to whatever of this company is equal to price to whatever next year of this company is equals to price to whatever of the group. Like it can be another company that's exactly like you. It can be the average of the peer companies. It can be the industry. It can be the market. Your assumption in your relative valuation is that the two multiples are the same. price to whatever, price to earning, price to book value, price to sales, price to cash flows, price to EBITDA, right? Whatever denominator of my company is equals to price to the same denominator of the company or peers or market or industry that I'm comparing myself against. That's the assumption. So therefore, if I want to find the price of my company, it's equals to price to whatever of my peers. In this case, it's EBITDA of the ratio that I'm using, whether it's company, peers, industry, or market. In this case, it's the peer average multiplied by my company's denominator. So my company's EBITDA. Which EBITDA? Which EBITDA? EBITDA in year 2021, 2022, 2023, 4, 5, 6, 7. What? Which EBITDA? It has to be a future EBITDA, right? Technically, EBITDA next year. EBITDA next year. So this could be EBITDA of 2022, or sometimes we can even use 2023. Either is okay to come up with the price of the company. But EBITDA next year. Earnings next year. Book value next year, right? Price to earnings next year. Price to book value next year, right? Always the next year's EBITDA or the year after. Sometimes we use the year after, right? To come up with the valuation of the company. So this would be so based on that, you would average this and multiply it by the adjusted EBITDA of 2022. And in the exam, I gave marks for both 2022 and 2023. Either using either EBITDA got marks, and divided by the number of shares, just because you want the per share value. Okay. You can do this on your own. We don't have time to discuss it. Just look at 2021 question number 3. Okay. Question number 3, part A, C, and D. I'm sure you can do the others as well. This was what I was going to discuss. Just look at that on your own because we don't have time. We start on derivatives after the break. So we start at 11 o'clock. Okay, 11 o'clock, back at 11. Okay. So we come to the introduction of derivatives. So we're a little behind in terms of where I wanted to be in the class. I mean, this morning it was not the greatest because there were technical problems and I couldn't log in. And so because of that, plus your participation was also poor. So we're a little behind, and that might actually work adversely for us. So everything that we caught up kind of we're going to like fall back on.